If you're looking for ISAs and marketing, please contact J. Lopez Enterprise, servicing all 50 states. What's going on? It's Jimmy Mortgage. It's Let's Talk About It. I'm your favorite lender. As you know, Let's Talk About It is a platform that talks about entrepreneurship, real estate, financial literacy, whatever you got going on. This is a show to be on so we could tell you what we're all about. Let's talk about it. Today I have my special guest. His name is Castleigh Johnson. He is a founder, CEO of a big company that he's trying to grow, and he's going to talk more about it and what he needs us to do and others to learn why his platform is very important. So I'm going to let him say the name so we make sure we do it right. Welcome, Castleigh. How you doing, brother?
Appreciate it. Hey, thank you, Jimmy. Good morning, everyone. Good afternoon, wherever you are. Castleigh Johnson, founder of My Home Pathway, fintech platform in the mortgage space geared towards helping consumers that have typically considered higher risk profiles, so a little bit lower credit scores, don't have enough cash to close, down payment money, or maybe your DTI is a little bit higher. But again, leveraging a tech platform, tech first approach to helping you understand where you stand in like just the underwriting process or the pre-approval process, and not just understand it, but build your profile to get you approved. And then we partner with, lenders. Jimmy, shout out to the work that you're doing that really want to help people get into home ownership. So it's a two-way benefit both for lenders and consumers and realtors as well.
Right. So, and then you're an authority figure because of what you're doing, but where you worked, right? You worked at some of the top industries, right? Let's go into that, right? You do have a degree at from Penn State.
Yeah.
You do have an MBA from the School of Stern, NYU, right?
Bro, shout out to both of my institutions.
Right.
Yeah, Penn State, again, Happy Valley, one of the largest schools in the country. Shout out to, again, Jocelyn Bennett in the School of Business there, Smill School, that gave me an opportunity on a Button Wallace scholarship to go to Penn State, right? So shout out to all those folks at Penn State University, NYU, which we're still working with NYU. We just did a capstone project with NYU last year, which the students at NYU helped us to work on a milestone project to help us understanding some markets that we need to tap into with our home nurture program, which is our pilot for the OCC, which is a regulator that we're expanding. We have phase 1 that we rolled out this year. We're going to roll out phase 2 in 2026. So those students helped us to understand what are the top markets that we need to be looking at in terms of going into those, extending that program.
Okay.
But yeah, in terms of companies, worked at the Fed, New York Fed in 2008 during the crisis. So saw some real interesting projects there. Some of them are public, some I can talk about, some I can't. But it really got me to understand banking and financial services and really what a lot of times people think they know banking, but they really don't.
No.
But there's a lot that goes into banking that is not quite consumers don't quite know it.
Right.
So the Fed really helped me to understand how banks work and how regulators work to support banks. You think about a regulator, they're an external auditor.
Right. Yes.
There's these rules that these banks, companies, financial service companies have to kind of guide by.
Right.
And an auditor or a regulator is going to come in and be like, hey, are you abiding by the rules to make sure that you're providing the right type of products, the right type of services to these consumers? But as all of that stuff is not really as clear. Then I've been at Goldman, AIG, Ernst & Young, Bank of Montreal, all on
all
the risk
these
side.
big firms, man. So the information you're going to be receiving today, I promise you, it hands down is going to be worth every penny because, again, he's credible. He's worked at some of the biggest firms. He went to some of the elite schools. You're going to feel comfortable knowing that what he talks about when it comes to my pathway of homeownership is going to let others feel comfortable when you're a little bit discouraged. You don't know what's going to happen because, we do get discouraged sometimes when the bank tells us, no, we're not qualified. Get simple for you and tell you why this is another alternative that he's created with him and his team and why this is going to work only if you keep yourself accountable with his team keeping himself accountable, right? Because, look, you put in the work, they're going to put in the work. You're going to get the house, they're going to feel happy, and at the end of the day, all we ask is that you share this information with those who are feeling the same way you're feeling or who went through the same thing you went through so Castleigh can help, right?
Yeah, so there are 3 to 5 million people every year that are rejected for mortgages, right? It's not you by yourself. So if you ever got rejected for a mortgage, don't feel bad. There's a ton of other folks that have also been rejected. And again, there's sometimes a stigma or a sense of shame when you got rejected.
Right.
It's like, it's okay. Like, you didn't know. And so, like, that's part of it.
Right.
Part of it is you didn't know what it really took to get there. That's our job.
Right.
Our job is to really help you simplify that process and to understand, like, what is debt to income ratio? It's leverage. Right. That's what a bank looks at. You know, what is down payment? Like, why is it important? It's your skin in the game.
Right.
You have some skin in the game that, you know, like, you're putting up some of this actual capital. And so that's just understanding the different language for the mortgage space and just financial services. It'll help to empower you to make better decisions. And that's really what we want. End of the day, how do we teach people how to make better decisions for themselves so they get better access, but also so you understand, like, hey, this is what a bank looks at me like. Right. And if you don't know that, you're just guessing. And so part of it, we don't want to reduce that guess game.
So what would you say to someone who's saying, you know what, I don't need to go check you out. I can go put this on ChatGPT and get the same information. Make the case.
I mean, ChatGPT is good, but you also have, you ever heard of some things called hallucinations with ChatGPT?
I just learned about that.
It can hallucinate you to get even worse spots. So it's come a long way. So shout out to all the models like Claude, Gemini, ChatGPT. They're still working on it. It's a progress, right? But it ain't there yet. So yes, it can give you some guidelines. And again, you can go back to old school Google search and it'll give you some high level stuff. But when it comes down to your personal data and assessment and what you need to do, you need somebody that has the experience and actually knows how banks move and how banks think in different ways.
Right, because different banks have different criterias.
And so again, ChatGPT is not going to know all that because the banks don't put that out in public information domain.
No, they don't. No,
so like, again, the information that was used to train these models was actually public domain information.
Right.
Banks don't put their criteria in public domain information. So if anybody tell you that banks gonna put their actual underwriting criteria in public domain, that's false.
No, because they need to make money.
So that's part of the thing, right? You want to make sure that you get people the right information.
Right.
And so, yes, you can plug that stuff in and it'll give you general guidance. But for you to actually get to, underwriting or to really good pre-approval, you got to know, like, what's my specific situation?
Right.
Like, how do I clean up my DTI? How do I increase my credit score? And what do I look like in terms of my credit utilization and how I bring that down? Right. How do I adjust my expenses so I free up more cash flow? Or how do I find the right down payment assistance programs that are relevant for me that I can qualify? And what are the different types?
Right. You did a good job when we were in Patterson. You broke down the different types of down payment assistance program, the DPA products. Can you walk us through what are the pros and cons when it comes to down payment assistance? Because I have those. I have, again, I'm a lender. You, of course, use me, but again, I want Castleigh from my home pathway to explain to you why he's important. So can you explain to me why what's the leveraging like and why is it important to have those credit criteria that you talked about?
Yeah, I mean, so down payment assistance programs.
Down payment.
High level. Let's just run that real quick. So it's usually when an institution or actually a city sometimes. So some cities have their own down payment assistance programs.
Correct.
Some states have their own down payment assistance programs.
Correct.
Some lenders have their own down payment assistance programs. So as a consumer, I'm already confused.
Right, yeah.
Like, who's what? Where does money coming from? What's the program? What I got to do?
Right.
So like there are levels to down payment assistance programs. And there are a lot of times lenders, at the end of the day, the lender's going to make the actual mortgage contract.
Right.
So the lender has to accept certain down payment assistance programs. So most lenders are going to accept most state down payment assistance programs, town down payment assistance programs. And again, you find the right lender and they have their own, you can like stack them. Right. So depending on the type of programs, and then there's different types of down payment assistance.
Correct.
So there are grants and there are forgivable liens.
Forgivable liens, yes.
And so the grants is free money.
Right.
Very few down payment assistance programs are free money. Now it sounds like free money. So you got to do some digging, right? Make sure you actually read the details. But I don't know the exact numbers, but let's just use 80-20. So 20% might be grants, which is hey, here's you qualify for this, like based on, sometimes it's for some nurses, firefighters, police officers specifically, or residents with lower income. So, average medium income is below 80%, et cetera, et cetera. So AMI.
AMI, right.
If you're looking for a title company that's easy and no headaches at closing, please contact Alan, Chief of Staff at Simplicity Title. They're covering the state of New Jersey.
So we're gonna say like, hey, some of this down payment money is grant money.
Right.
Grant you can consider free because grant typically comes with no real strings,
right,
no restrictions. Most times, even that, there's some of the programs may have some restrictions in the free money.
There's a criteria in that bucket
Yes.
that you need to adhere to.
Yeah, so there's you got to look at that,
Right.
right? So again, when we're talking free money, and I'm using air quotes for that real quick, it's because like typically it's not like a recourse product.
Right.
They're not coming after. They don't have a lien on your home.
Right.
And so the other parts are, where there are recourse products.
Mm-hmm.
And so there, again, you might get a little bit more money with a forgivable loan, or you may get a little bit less money with a grant. For example, let's use a $5,000 grant, free money,
right,
give or take, right? Or a $20,000 forgivable loan. But the forgivable loan is from like the city of Newark. Let's just use that.
Right.
And the city of Newark tells you that you cannot sell that house within 3 years.
Right.
You got to live there for 3 years, for example.
Right.
Again, can't get another house on top of that. So they got some restrictions.
Right. Right.
They want some tax benefits. They
Right.
want you to stay there. They want you to build in the community. They want you to like create more of a home ownership mindset within the community or the city of Newark.
So they give the rich folks builders tax abatement. They give you down payment assisted.
And understand, the developers and the folks that are building this stuff, they're sometimes getting 10, 15, 20-year tax abatements.
Yeah.
Right? So like you might get like a 3-year joint and be like, you have to live here for 3 years. But
right,
if it's a big development, they got a tax abatement.
They got
that's really how
yeah,
you incentivize folks. All
right,
things are incentives when it comes to finances.
Right.
Right. So you got to think like, what do I got to do to go get a developer to put $20 million in,
right,
30 homes or whatever, or 50 homes.
And keep in mind, they deserve it, right? Because they're gentrifying the community, right? In their mind, if I could put this in here, and
it's tax revenue,
right?
So
it helps
from
them out.
The city,
right,
think about it. The city's like, hey, if I got 30 new homes in here on average, I'm charging you 3% taxes,
right,
on the assessed property
the assessed
value.
Property, yeah, that part.
Not the sale price.
Not the sale,
assessed
right,
property value,
right,
which for brand new homes sometimes it can be a little closer. Depends,
right,
but let's say assessed property value $400,000. I'm going to charge you 3%, 3.5%, whatever the percentage is, for that city. They get revenue from the brand new homeowners coming in, right?
Yeah.
So for them, it's property tax revenue.
Right.
So you kind of like, all right, I'm gonna give the developer a tax abatement, but I'm getting new fresh taxes coming in, right? So that helps my budget.
It's a win-win,
yeah,
right?
It helps my budget,
right.
So like you got to think these are all the different things that come into play that as a consumer you never have to worry about, to be honest, right? But now you get a little. It's like looking behind the curtain a little bit to say like, hey, why these cities have 50 developments going on all at the same time because their city council have negotiated, right, with a bunch of developers like, hey, come in. We're open for business.
Right.
Bring in your development teams. Here's some property, or here's property sometimes sold by the city,
right,
or sometimes another investor, or sometimes another property owner that you can get a really good deal on and be like, hey, I'm gonna put like this unit, whatever, condo set up, or additional units, multifamily, et cetera, and you sell those things, and now you have property taxes.
Right.
But from a consumer, when you're buying it, you want to be able to say, like, again, depending on how much money you earn, sometimes there are these programs that many folks don't even take advantage of, right? So if you're thinking like, hey, I'm interested in home ownership, one of the real big parts you should look at, again, look at down payment assistance programs. And the other part that goes with that, again, this one can be annoying. There's two pretty much annoying things with down payment assistance programs. I'm going to keep it 100 with you. One is the application process itself.
Yes.
Some of those application processes are tedious, and it's not as straightforward. And you're sending it, to a, at whatever email, and you never really know if it's actually being accepted.
And it's their underwriting too sometimes, right? Because they pre-screen some of that stuff.
Correct.
Right? So you got to be careful when you're completing that.
So again, that's one of the processes. Then the other side is like sometimes they have you take these home buyer education courses. Right. prior to you to be able to qualify, and a lot of people don't take those. Right. So again, in our platform, we'll actually help you to be able to take those courses, and we'll send you the reminders. We'll get you to make sure that you take the courses so you have the certificate to qualify for it.
Right.
Because without the certificate, a lot of times you won't even be able to qualify for these down payment assistance programs, which again, if you're, trying to buy a home in like 2 weeks, 3 weeks, 4 weeks, and you have to do all this stuff. You got to search, you got to get pre-approved, you got to think about taking this homeowner education course. There's a ton of stuff. You're looking in different neighborhoods, yada, yada. You got to do your own research on the properties. When you're trying to jam all of that into like 2 or 3 weeks or a month, it can be overwhelming.
Yeah, that's what I'm about to say.
You don't know property taxes. You don't know what assessments look like. You don't know what tax appeals look like. Except that's, again, right after you get home, jump on that too.
Right.
But there's so much information. And so like in our platform, typically people that are a little bit higher risk, we're working with you for 6, 7, 8, 9 months, right? So we have time to help you to understand all of that.
Right.
Most folks going into a home buying process don't even know what a 203K rehab is.
No, they see it on social. They're like, yo, this is what you do. It just does renovations. Like, no, there's
a lot of stuff.
There's a lot that goes into it, right? It's a non-traditional product that it costs a lot more up front. But if you feel the home is worth it and there are things you're going to do and recoup some of that money after repair value, then it makes sense. But you have to understand the beginning part of it.
But again,
and money's compounding.
The money's compounding. It's a lot of stuff. If you've never worked with a general contractor before, there's a lot of information that the city, the permit structure.
Every town is different. Yeah.
And so all of that, like from the first, if you're a first time home buyer, let's use that. If you're, you've done it 4 or 5 times, you bought a couple houses, you kind of understand the home buying side of it, maybe not the renovation side of it. So you can kind of get to like, this is what it would look like going through the mortgage process. But the rehab, renovation, like there's so many things that you got to take into consideration, getting the right contractor, making sure that they know what they're doing, they're bonded, et cetera.
Right.
Like all that stuff is just like being prepared.
And you're helping them because you know who are the consultants that are doing some of this project. And to go further, you know some of the realtors that know the area well to make sure administratively things are getting done, right? Because that's another thing, right? Some towns you can do things in 1 day, and some towns it could be 2 months. And depending on what's going on with
some towns only like review permits like once a week or once every 2 weeks. And so if you miss that like timeline when they're reviewing permits, you might not get your permit looked at for another 2 weeks. That pushes off your completion schedule, right? And if you fail on the permit review, then that pushes you back even further. So like you take some risks, right? So you got to, again, make sure that you come into the game understanding like, hey, what do I want to do? Right. Because again, a 203K rehab could be beneficial to you if you can get the rehab done and then the reappraised value is 50, 60, 70,000 more than the purchase price plus the rehab.
That's when you know it's worth it.
That's when you know it's worth it. But the math got to math. But if you don't know how to do the math in the first place, or somebody like a GC, a general contractor, GC, potentially might take advantage of you, and then that 50,000, 60,000 gap that you thought that you had can go to like minus 20,000.
Easy, real quick too. And again, that's what the platform does. I mean, a lender, like I'm going to explain to you, but if you want to get another certainty about what's going on, your platform provides that, because you're going to say, okay, you spoke to Jimmy. Did Jimmy go over this with you? Did Jimmy tell you what can happen if this does not execute? Did Jimmy go over this? Blah, 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 blah. And it makes you feel good too, knowing that a lender is doing the right things, because there's a lot of lenders that are not doing what they need to be doing to help people get into the home ownership. Sometimes it's just a transaction for them, right? Yeah. So I mean, I'm not going to go there, but it is what it is.
You got to have the right lender, right? Because the folks that really truly care about you and getting you into a home, and not just getting in. So the part about home ownership, there's 2 pieces to it, right? There's the actual getting in, and then there's sustainability, which means staying in, right? So there's the origination and the sustainability. Super simple. You got to be in your house 5 or 10 years to really build equity. And so typically you just don't want to think about like this is a transaction. This is a foundation. And so you got to be able to trust your lender and be able to work with people that got your best interests at heart. Because again, this is one of your biggest purchases of your life, right? This thing can help your family generationally and your kids, if done correctly. put them in a place to build equity. The average home equity last year was like $330,000, $320,000 last year. It's going even more, right? But you have to make sure that you have the right purchases that will get you access to that equity, and you're not going to get that equity immediately, right? It's going to take some time to build, and somebody got to explain that to you.
Looking for insurance to insure your home or automobile? Please contact Alexia at Allstate, located in New Providence, New Jersey, servicing clients in the state of New Jersey.
There's a big piece of education. The other part I wanted to like to say is like there's an ownership mindset, and then difference between a renter mindset and an ownership mindset.
Right.
And people have to make that change, right? When your boiler breaks, you ain't calling a landlord. You have to call a plumber.
Right. You gotta.
Right.
Yeah.
Or you got to learn, get on YouTube and figure out, am I going to be the DIY homeowner where I'm going to be learning how to change my boiler, how to like make small, changes and updates in my home myself. You got to make those decisions, right? But those things are, things that you can learn or decide, hey, I'm going to be, Angie's List is my friend. I'm going to look up a bunch of like trusted contractors on Angie's List or whatever.
Right.
But all of those are different decisions that you need to make as a renter, potentially, going into your first time home purchase to be like, hey, these are my roof, right? What is the average replacement life cycle of my roof?
Right.
And the type of roof I have.
Right.
Right. Is it shingle? Is it shale? The different types of roofs have different life times. So you want to make sure that you do your research on that. The boilers. Average 15 years, depending on whatever
15 years today? Well, if you get a boiler 15 years,
again,
let me
but
get that boiler.
You might have to pay up for that 15-year type boiler, right? So you're going to pay, instead of like whatever, $1,200-$1,500, you might pay $4,000 for that boiler. And it might last you that long, and you might have some quality stuff. But again, understand that these are all different things that come with home ownership. The mortgage and the pre-approval process is
just the beginning.
Critical one.
Right. And it's also just the beginning.
Yeah, it's the beginning of the ownership process.
Right.
So that's why you, again, when I said a mentality shift, you have to start getting into the mentality of an owner, right? From the time you're going to talk to your realtor, time you're talking to, your mortgage lender, time you're on our platform, right? Spend that time to understand what are all these different things. What is again, if you're buying a home in an HOA, what is an HOA?
Right.
What can it do? What can it do? What are my HOA dues? Right. If you're again getting into that, what's private mortgage insurance, PMI, versus homeowner insurance?
Right.
They sound similar, completely different things. Right. And so all of these like small things that can add up. Your property taxes. How are those assessed? What is an assessment? What's the difference between my property tax assessed value and my actual mortgage? Right. Those are things that are like, you can confuse you, right? And so you want to arm yourself and put yourself in the best position to be as educated. You don't have to be an expert, right? Because I'm not a doctor. That's why I got a bunch of friends that are doctors. I can call them because they're experts. They've spent the time to learn everything they need to about heart surgery or, whatever it is, primary care. And so you need to be able to find the folks. Again, that's what our platform is doing. We're building that entire infrastructure so you have a place to be able to just jump into and find the right information that puts you in a space to be, to put you in a better, more comfortable space.
Yeah, and again, the platform answers the questions, the what if, and so on and so forth. And also, one of the biggest things that happens to me sometimes, and I explain it, but, at times people have selective hearing, and it's okay. My mortgage went up. I'm like, you're in a fixed rate. Your mortgage didn't go up. Your taxes and your homeowner insurance went up. That's the thing that this platform can provide. Like, if you're getting stuck, it's not like it's set it and forget it. This platform is following you so you can have these questions to help educate you, not feeling like, oh my God, something I'm not sure if I asked that question. You asked the question, you probably forgot because, life happens, life is life, and like we said, but going back to your platform, those questions are there, those answers are there, and it can always help with that, right?
Yeah, I mean, again, there's so many different types of mortgage products, right? Let's think about it. There's a 15-year fix, 30-year fix, there's ARMs, right, adjustable rate mortgages, right, interest only. Some people coming back with interest onlys. I would not recommend the interest only if I'm just personally, because it's a very it puts more risk on you as a consumer, right?
It's not meant for everybody.
Yeah, it's not meant for everybody. Not to say it's a bad product, right? There's people that it's perfect for,
right?
But for the average person, right, probably not the right thing for you. But again, as Jimmy just said, your mortgage payment went up. Your mortgage payment didn't go up. Your payment overall went up. Right. So if you're thinking, if you have a fixed 30-year, fixed 15-year, whatever that duration is, or the time of the length of the mortgage, that payment is going to stay about the same. But you're right. The mortgage insurance is going to go up, or it can go up. Once in a while, it may come down. Very rarely. That's a very rare.
Wow. Take a picture if it does.
If it does, take a picture.
Take a screenshot. Yeah.
Post that on IG. Post it on IG. Give your mortgage company a shout out. I mean, your insurance company a shout out if that happens. Right. And then your taxes. That ain't going down. No. Like whatever your taxes is, it's probably gonna go up.
Yeah.
So you gotta, again, somebody has to give you an idea of if your taxes are, again, there's a tax rate and then there's the assessed value. And so both of those can go up. More than likely what's usually gonna go up is the assessed value. And so you have to understand, like, hey, was my property assessed in the last year, 2, 3, 4 years? Give or take. Some towns will tell you we reassess properties every 5 years. We reassess properties every 10 years, depending on your town. And so if you just got assessed, you're probably okay, again, in the last year or so. And you can ask your town, call your town assessor. Like, hey, when's the last time? What's your schedule? Right. And they'll tell you, like, every 5 years, every 7 years, every 10 years, whatever that schedule is. So, again, if you're 1 year in and it's a 10-year, I got a good 8, 9 years before I got to worry about this. Right. So, again, but these are things that we talk about, the ownership mindset. You don't want to guess.
No.
Being a homeowner.
No, you
the
don't.
more you actually are proactive and the more you take control of this, is the more you can plan. Right. And the more you can put yourself in a better position. So if your tax assessment did go up, right? So you bought it at $400,000, your home is worth $1 million now, but they assessed your property taxes to $800,000, for example. They're going to actually, or say $750,000, your property taxes is going to jump. They might actually pull the rate down a little bit, right, to not double your taxes. So again, those are considerations that you have to think about. And as a renter, you never had to think about this stuff.
No.
Super simple. As a renter, I recommend everybody get renter's insurance. Why? It gets you to understand what a insurance policy is going to look like on property, even if it's just your apartment. It gives you that first step to be like, hey, what does a homeowner insurance policy? It gives you that first step into getting. And actually, a lot of times your company, if you already have a renter's insurance, they'll be able to transfer it over into a homeowner insurance policy. So it can happen that way. But why I recommend it is so you can get familiar with the language, right? You know what coverages are. You know what addendums are, right? You know what exclusions are.
Good habits save you money, I promise you.
Yeah. So, I mean, that's part of where the benefit is, to just make sure that you're as prepared as possible. Again, our platform, myhomepathway.com, go sign up if you're interested in home ownership. And if you're already like approval ready, more power to you, right? We'll be able to hand you off to Jimmy, be like, hey, Jimmy, this person's good.
Yeah, let's do it.
Like, let's rock them. Right. But if you aren't, again, for a lot of folks that you're questioning your credit score, you know what a good credit score is. I typically am pushing for folks to get to at least 700, which is prime. Why? Because your cost of capital, not just for your mortgage, but your entire life, your credit card, your student loans, your auto loans, all of those things. When you think about your credit score, think about that as access to capital, right? And your credit score kind of controls your access to capital for all things that require credit, like your mortgage payment, like your credit cards, like your your insurance.
Your insurance, yeah.
And so you want to be able to put people in a space where you're comfortable in multiple places, not just like the product that you're thinking about.
And going back to your point, right? And some people will always compare, why is my insurance higher than this person's insurance, blah, 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 blah. It could be a lot of different things, but one of the main things is because of credit. So not everybody has the same credit criteria you do, right? And as we know, insurance is based off of risk, right? So
payment risk. Yeah, that's really what it is.
It's looking at that. So sometimes someone can have a higher one, have a lower one for whatever reason. That's why, again, it's important to go on your platform to make sure how I'm feeling about before taking this insurance provider or this insurance provider, that I know this was I check these criteria. It's like, all right, my credit score is here. This is why this is why my insurance is this cost, right? Or something happened. This is why this happened. Again, your platform provides all that information to explain step by step, what does it look like, and to, be careful my words, not make you feel nervous. I was about to say something else. I just caught myself. I was like, all right.
It's demystifying, right? The simplify, we're going to demystify. A lot of it's like, again, is in like almost like a shroud of mystery. Like, bro, it ain't, it's complicated, but we can still be like broken down simply for folks to be able to execute, right? Because we want to put people in a position of, power in their own finances. And too many times, like, you're guessing, and when you're guessing against a financial institution is never good. Like it's a contract. Contracts are like little mini battles, like whether you realize it or not. And so the more you can be prepared and have a better footing for what you need to know, like, bro, okay. And sometimes you got to be able to know when to accept and when to walk away. And without the information, you don't know, because sometimes it's legit. Like, this is a true cost. Like, you are this risk, or you have this much, what you're looking at from different organizations.
Right.
And so they're gonna be like, no, this is what it is. And you have to be able to say, all right, true, I get it, right? I understand. But when you don't understand, it's going to be like, well, are they playing me sideways? No, this is where you stand for real.
Right, yeah, this is what it is.
Yeah.
You also mentioned, too, the other day, I watched you talk about how you're advocating that credit bureaus take into consideration rent. Because you said 40%, I think, was it right?
40 points.
40 points, excuse me. 40 points is attributed to
payment history.
Payment history.
Yeah, it's all.
So, and you mentioned, it's like, they should start doing that now. You should start trying to get your rental history onto your credit report.
Yeah, I mean, at the end of the day, that's one of your biggest payments. And so it's typically your rent is about what you pay in mortgage, give or take, like a 10% variance here or there, like difference. And so if you're not reporting that, you're literally giving up anywhere between, on a low side, 30 points to 50 points on your credit score, right? That's a huge jump for most people.
Yeah,
right. So if
600 is 620, 640. That changes everything.
Yeah, 640, 650.
Yeah, it changes everything. Right.
That's an easy jump. Now the challenge is you have to pay for it right now. So to get it in all three bureaus, there's I think Experian has it in Boost, but it'll only increase that credit score. It won't increase the others. So you right now,
Equifax, you need
you need to get all three. So you'd have to have a rent reporting embedded in all three. So you got to pay for that. So you have to take the proactive step as a renter to embed rent reporting into your credit score as a trade line. That's what they'll do. They'll put it as a trade line. And then there's two different parts of rent reporting. There's the 24-month look back, where they'll check, hey, did you pay your rent in the last 24 months? And that's the big win, is when you got the 24-month look back, and you get anywhere between, again, 30 to 50 points. And then you can continue to pay for it going forward, and it'll also increase your score. So there's two parts to it. You want to make sure that you're doing both sides, and you get a pretty significant jump.
Okay. Yeah, so recently you talked about, putting your rental into your credit bureau, and you said it can go anywhere between 20 to 50 points.
Yep.
Can you break that down a little bit?
Yeah, so, right now, most people who are renters do not have rent reporting embedded into their credit score as a trade line. So you're losing that 20 to 50 points. But there's two parts of rent reporting. One is when you pay for rent reporting for the 24-month look back, which adds 24 months of payment history to your credit score. And so that's the bigger jump. That's where you're going to see anywhere between that 30 to 20 to 50 points. But you can also pay for it continuously moving forward from the time you sign up for it. And I think it's a monthly fee, depending, don't quote me on it, like $5. So again, and you can get another 15 points of your score within the next 9 months. So
I think it's worth it. $5 off an
more
interest?
It's more than worth it. And then for the 24-month look back, some more places charge you $50. So that math be mathing. So let's run that. If you want to do that math, 50 points for $50 for 50 points of your credit score, bro, do that math all day.
It's to go to the point, right? Let's say, for instance, you have a 719. Your pricing gets better on 720. So that $5, you were like, nah, I don't think about it. Just because of that, you can save maybe an eighth or a quarter off your mortgage, depending on whatever sheet you're using that day when it comes to pricing.
That's the best $50 investment.
That's the best $50 in your life, because remember, one is compounding, one is just like, let me just give it to you, right? So you gotta be mindful of the fact that if you're trying to boost your scores and you know you have good payment history with your rent, right?
Yep.
Good payment history.
If you got a little spotty rent,
don't ask for it.
Don't do that. Like, we're not trying to set you up.
No. But if you have good payment history with your landlord, you want to put that in there because again, that can change a lot of different things. And in some cases, you can qualify for that particular product within that area you're looking for because, like you said, there are programs that are available in certain neighborhoods. And if you have that good credit criteria and that DTI, going back to that, leverage, you can get into this home. So this means plenty. I'm going to jump into what we all think, what we've been hearing, this administration. What do you think about this current administration and what they're trying to do with the housing market? What do you foresee happening in the next couple of months?
Well, one, I ain't Nostradamus, so I'm gonna call it as that.
Right.
But if I'm gonna take an educated guess, I think you're probably gonna see a new Fed chair next year, and we're already seeing cuts at the Fed level right now. So whether that's another 25 basis points or 50 basis points, probably see another 25 basis point cut this year. And then next year, you're probably going to end up seeing like 50-point basis cuts whenever a new Fed chair comes in to kind of increase economic activity. With increasing that economic activity, making capital cheaper, you're probably going to see some push down in interest rates on the mortgage side. Now, we do have, inventory, more inventory than we've had in the last couple of years on the housing market, but the prices are still higher than a lot of first-time buyers can afford. So there's still a bit of an affordability, not necessarily just from an interest rate standpoint, but from a price expectation from a seller perspective. So, there's a little bit of a gap that still needs to be.
He worded it nicely. These sellers are looking for some enormous numbers. Let me just keep it simple. He worded that nicely. Yeah. These sellers looking for some buka numbers. That's what they're looking for.
I mean, if you see real estate prices run up 20%, 25% in the last 2 years, give or take. And I'm a seller, I'm going to try to just hold out for that 25% because I want to exit at where the top of the market is, not like coming down.
I want what's mine.
Yeah. So it's a hard conversation, right? But there's market expectations and then like what the market clears at. So if you're sitting on your $1 million listing, like, oh, I want this million, and really it's an $850 house, that's a change in reality. And so a lot of people don't want to like live up to that change in reality. So it's a hard kind of conversation right now. Plus, we're still 5 or 6 million homes short on new inventory, not new inventory, but like home supply, period. So there's a dearth in building of affordable, remember there was a concept called starter homes back in the day. We don't even build starter homes no more. No. Everybody wants to build the 3,500 square foot plus.
They want estates.
Right? Yeah. And so like, bro, your first home slide into a 1,500, 1,300, 3 and 1.5, right? And a house, condo, townhouse, et cetera. There's a ton of those, but we're missing that inventory overall in the country. Like first time you stepping into the housing market game, you can buy a condo, a townhouse, 3 and 2 or 3 and 1, the single family, early, married couple type stuff. So we have a ton of that's missing, called missing middle. Our first time home
that
buyer.
entry point.
That entry point, yeah. So I think there's a huge opportunity. So whether that's going to be prefab homes, concrete construction homes, there's a ton of opportunity for someone on developer side or some organizations on developer side to fit in that gap. And that gap is $1 trillion gap. So there's a huge opportunity on that piece. But I think you're going to see some price correction in the market. So again, what that correction is, 5%, 10%, 15%. Who knows where it's going to settle, but you're also going to see interest rates come down a bit. So that'll hopefully put some skid the wheels on the sellers and the buyers. Because again, there's more inventory on the seller side than there are buyers right now because again, where the price expectations are. So until we kind of get closer to where, the market can clear in terms of people's income. Because again, at a buyer, my limitation is income.
Right.
My income, if it ain't gonna jump 30-40%, I'm stuck, right? I can only afford 5, 6, 700,000, right? Because my income is there. But if you're as a seller, like I'm gonna sell this thing at $850, and I can only afford $650, like we're stuck. And if there's too many of those types, right? Again, sellers that are just like stuck there, and buyers that are stuck at a certain place just because of income, We got to find a better middle
You got to
ground.
deflate that balloon.
Yeah,
You got to deflate. Yeah, but
it's hard.
Yeah, it's hard. And the reason why I asked that question, because one, I mean, let's give him his props right now. He's meeting with these stakeholders. He's meeting with the agencies, Freddie and Fannie. He's meeting with the executives at some of these lending institutions. He's meeting with the risk management folks at these behind the scenes with lending institutions.
Yep.
Because at the same time he's growing his platform, he's also seeking knowledge to provide for you on his platform. And the reason why he was interviewed on the New York Stock Exchange with Jody talking about his fintech platform. What was that experience like, brother?
It was great, man. Shout out to the entire stock exchange team.
Right.
Judy Shaw. Shout out Michael Campbell. Okay. Mike, I gave you a shout out. So we got a link again. Again, they're big proponents of equity across the financial services space. So, they've been supporting our platform for a few years now. They've made the introduction to ICE Mortgage, which is another ICE owned company that pretty much 60% of all mortgage applications go through their platform. So ICE is a major player in the mortgage origination space, which is actually one of our partners now. But in general, and again, it's really around how do we help people get better access to home ownership and better financial access in general. Mm-hmm. And again, for us, we want to put people in a place of sustainability. It's not just a check the box like, hey, you got 620, you can get into a mortgage. And there are products at that space, but I want to put people in a place where they're comfortable. And from a bank perspective, the risk comes down, right? Just from a numbers piece. Mm-hmm. And the 680, 720 is much different from a 620 and a 580. Yep. And so that bank wants as many people up in that 680, more closer to the 700, 720 range. And so that's where it works for everybody. Mm-hmm. That's where we're trying to get folks to understand as a consumer, this is probably a better space for you to be. As a lender, this is a really great space for you to be, because then you have share of wallet opportunities if you're a traditional bank. Credit card, auto loans, mortgage, all that.
And to your point, right? Look at it this way, right? If you have a 620, it's like going to the junkyard looking for someone to give you some parts. If you have a 700, that's pretty good. I'm not saying they're not going to look at your overall risk. They're going to look at it, but you're stepping into the game better. You're stepping into the game better. The package looks that much better, right?
It does.
So that's how you have to look at it. Not to say it's not impossible to get a house at these scores. We're not saying that. What we're saying is, if we can get your scores higher and you can wait a month or two to get to that point and save money in the future, why not, right? And why not use My Pathway Homeownership to get there, right? Yeah. Why not use your app? Why not have those conversations? And then some of you are going to ask, well, how do you stay in business if you're not asking people to pay for your platform? Can you jump into that a little bit?
Yeah, I mean, we're supported by a couple of our foundations for some of the stuff that we've done before, but also our mortgage partners and our other partners that we work with are our revenue partners. So from a consumer perspective, it's free to leverage our platform. Our guidance is geared towards helping you fix a gap that you have in your profile. But our revenue stream comes from our partners, and so it's not like we're not charging you, but we're getting paid from our partners because they're getting revenue once you close a mortgage, right? So we're tying everybody's incentive together.
I had to ask that question because you know how some people is, Jimmy again putting this stuff out here like they're gonna try. No, this is all free. Again, the more we advocate for you to save money, it makes sense for the platform to do what it does best, because his partners are gonna be like, yo, we're doing the right thing. It's making make sense, right?
Yeah. It got to be aligned for everyone, right? Mm-hmm. Consumer gets a home, mortgage company gets revenue and revenue, and then we also get paid for helping you to become a better risk for that partner.
That sounds crazy, right? The lending institution is helping this platform help you save money. Banks are about making money, right? So this is what the platform is doing. That means they believe in what you're doing.
Yeah, because at the end of the day, it's risk for a bank too, right? So they want a good qualified consumer. And so the better risk you can show up on their door with is the more they're more confident that you'll actually pay me back long term, right? So it's a delinquency thing. Like, again, delinquency, default, That's the part where banks hate. And
They don't like foreclosure. They don't like that stuff,
again,
man. They
the
don't
better
like
you
it.
show up,
Right.
is like the less risk you have, and the more likely they'll be like, oh, Jimmy's gonna pay me back. I'm good with that.
Yeah. So, man, Castleigh, thank you so much for hopping on Let's Talk About It. If people are looking for you, where can they find you, brother?
myhomepathway.com. Jump on. If you're, again, interested in home ownership, sign up. You'll see us online. You'll see us in a couple of local events. We're mostly in the Northeast for now, but we'll be across the country. We've done stuff in Newark, Patterson. We're doing stuff across a few more. Detroit's coming up, Chicago as well. So again, anywhere across we're available all across the country. Our partners, again, have access to lend across the country. So if you're anywhere in the country, sign up, myhomepathway.com. And we're currently in fundraising mode as well. So if there are any VCs and investors that are looking for fintech partners or fintech platforms in the space, please reach out to me or jump on our site, Castleigh at myhomepathway.com, and looking forward to hearing from you guys.
I appreciate you, brother. If you're looking for conversations like this, of course, you know where to go. Let's Talk About It. I'm on your favorite streaming platform, Apple, Spotify, you name it. Put in Jimmy Mortgage. Let's talk about it. I'm here to help. And again, Castleigh, thank you so much for taking your time to come on. Let's talk about it, man. I appreciate you, brother.
Appreciate you. Thank you, guys. Enjoy the rest of the day.
Looking for a real estate lawyer servicing all real estate need? Please contact John Georgie, servicing the state of New Jersey.
Hey, listeners, are you looking to improve your home comfort and save on your energy bills? Let's talk about Seal Power. They've been awarded Energy Star Sustained Excellence Award, seen on Good Morning America, the New York Times, and World News. Seal Power is dedicated to keeping your home cozy while saving money. Check out their website for tips and incentives and more at CIELPOWER.com. Stay comfortable and save with Seal Power, where comfort meets efficiency. Follow them on Instagram for updates and more, and Let's Talk About It as well. Thank you.